What's up, all my stock market investors? It is Shadai, and I'm back again with another Cash App investing video. And today I'm going to be talking about how to profit from a stock market crash for beginners. All you pros, just move all along. This might not be the video for you. Now, if you look at history, it will show you that over time, after every crash, the market recovers on its own. It works its way up. And usually, when it recovers, it's a nice lengthy time period when it recovers. And you need to understand that if you're getting into this, a lot of people are very confused about how they can make money. If you're getting into this, you kind of have to be in this for the long term. I think that history and statistics show that if you invest in this market while it's down in the long term, and I can't say how long that period is. It could be 2 years, it could be 3 years, it could be 1 year, it could be 5 years. But if you're willing to invest for the long term, you will win. Obviously, as long as you invest in the right companies, because this the whole thing is strategic, right? But you need to be looking to invest in the long term, the long end goal. You see on the chart that it shows in 2008, after the market crash, it did a nice increase. In 1982, after the market crash, it did a nice increase. And we really can't predict what's going to happen in the short term period. No one really can predict. People can guess, and sometimes they can be right, sometimes they can be wrong. But statistics and history show that if you invest into this market during a crash and have the expectations of long-term investments, you will be happy in the end. Now, you also want to be buying stocks when they are low, not when they are high, not when you see a plus sign. You have to focus in on what stocks you plan to buy, and then whenever you see those stocks go lower, that's buying opportunity. Whenever you see those stocks crash, that's buying opportunity. And don't second guess yourself, because if you second guess yourself at the point of purchase, it's going to be bad. I did it to myself a few weeks ago. Specifically, JetBlue had hit history low, in the last handful of years. And I really sat there and told myself, oh, it's going to get lower. And guess what happened over the next few days, few weeks? It started to spike back up. So it's like I second guessed myself. Even though I knew it was the right moment, I second guessed myself. And you have to understand that if you do the research, you understand everything, that's your opportunity. You can't just like be second guessing yourself. You got to be willing to take the risk. If you've done the right research and you understand everything, you can't second guess yourself. It's a long-term investment. And if everything aligns, you got to do it. You kind of got to just go for it if that's what you want to do. But along with that is that you want to make sure you're buying a good quality company. Now, a lot of people have their own definition of a good quality company. Some will call it a blue chip stock. Some will call it this, that, the third, whatever they feel like calling it, whatever. As long as you understand what a good quality business is. Obviously, first, the good quality business needs to be making money. So if the company that you're looking at is not making enough money to pay their debt to equity ratio is not looking good, their PE ratio isn't looking good, their PEG ratio isn't looking good, their beta isn't looking good, you have to start to question whether it's a good company or not. If they're not making money, if they weren't making money before the recession, you really have to think in your head, are they going to make money during a recession? There's a lot of companies that people are investing in right now, and I feel so bad. And they're only investing in it because it's a nice cheap price. They're hoping for the best, and I get it. When you don't, this is an interesting game, and it's very strategic, and it's hard to understand. But the cannabis, like for example, the cannabis industry was not making that much money before the recession. Now, who knows? We don't know. Maybe they can make even more money during the recession, but they weren't really making money before the recession. So now more people are probably going to get laid off. Everything's just, you have to, your company has to be doing good before this. I personally think, unless that they can capitalize off this recession, that's a whole different other conversation. So make sure you're looking at all their statements, all their ratios, and that will determine whether it's a good quality business. And it's very simple, everybody. Google, oh my God, you'll never believe it. Google will find every answer for you. What's a PE ratio for Coca-Cola? What's the PEG ratio for JetBlue? What is a good PEG ratio? What is a good PE ratio? What is a good debt to equity ratio? Can you compare? You can compare companies. Like Google will do 70% of the work, 80% of the work for you. So make sure you're figuring out what a good quality business is. And then lastly, you need to understand the business. If you don't understand the business, you really can't understand how they make money, right? If I don't understand that Coca-Cola sells a drink to a customer, or they sell drinks to businesses, they sell drinks to stores. If I don't understand that, I won't understand how they make money. So how can I determine by myself that it's a good company if I don't understand the business? You need to understand the model, how they make money, and it needs to process in your head. Does that sound like they're gonna be continuing to make money, or they're gonna maybe not continue to make money? Something like consumer staple, it's going to continue to make money in a recession because people just need these low cost things just to get by, just to give them a little push in the day. They need a Coca-Cola or a Pepsi or a Gatorade to push themselves through the day. So understanding the business is very key too, because at the end of the day, you're still taking chances no matter what. Like I don't think there's one option that you could choose as like, yo, my risk is the lowest out of everybody's. Like, no, because it's unpredictable. Anything can happen tomorrow and flip this world upside down, as we clearly see what is happening now. So understanding the business is very key. Now let's look at a business that maybe it can give you guys a good understanding as to how to look at it. Now the company I'm going to look at today is OUTFRONT Media. And if you don't know OUTFRONT, I know you've driven by a highway on a street, and you see a nice big billboard. Next time you see that billboard, look up and see if you see OUTFRONT, a tag that says OUTFRONT on it. They pretty much have real estate, but real estate that has to do with advertisement. So billboards, that's considered real estate for many of you who don't know, because they have a little section of the ground where that base of the billboard has to sit, and that they own that, I'm assuming. I'm not going to go into all the details, but currently this stock is at $11.67 as I make this video. They're down about 50-60% on the year. And one of the main reasons why they're down, because I understand now, like when I'm looking at it from a long-term perspective, I clearly understand how they're making money. They own this real estate, this billboard stand. I get their expenses would be having to, put people on to fix the things, to go up there. Some old billboards, they use paper. Now some OUTFRONT is transferring a lot to digitally, which brings their cost down, because now they don't have to send someone out to switch out a piece of paper. They don't have to send a couple guys to switch out a piece of paper. They hit a button at a desk, and voila, there's a new ad on the screen. So from a long-term perspective, if OUTFRONT Media can fully go all digital within the next 10 years, they're cutting costs, right? Also, a lot of their revenue, more than half, is coming from Los Angeles area and New York area. Those two areas are being like super, super affected right now with this pandemic. Now, what does that tell me? That everything's like their money's gonna go down, and because these areas are down, right? These are two high volume areas that are down right now. That will, I believe, eventually pick back up. It's New York and LA. Like those are the two most densely populated, big cities in our country. So To say that they're never going to recover or never be high volume, it's just hard for me to believe, right? So I know what's happening right now. The stock is down because their biggest areas, their biggest markets are pretty much on shutdown. New York has like the highest amount of deaths in the country. So I clearly understand. I'm fully understanding the how the company works, what it's doing. I still have to look at all the ratios and all that, but with research, with time. But if this stock drops below $10, I mean, I think it's a buy now. But if it drops below $10 on the next crash in the next few weeks, uh, this stock can make people lots of money. It can make people lots of money, right? So just a quick little recap. Long term, buy on the dips, buy good quality, and lastly, make sure you understand the business model. I think it just makes you feel more comfortable when you can understand the company. And the research is all out there. Just remember, the research is all out there. Hit the Google. Just ask Google the question. You'll be surprised what happens. You'll be surprised what happens. All right. Make sure y'all hit the thumbs up on this video. Make sure y'all subscribe if you haven't. Have a great rest of your day, and just be prepared for more bad news. Peace.